Good day, investors. Celestica just dropped its Q2 numbers, and they were massive. Revenue came in at $4.7 billion. That's up 62% year over year. Adjusted EPS jumped 83%, and management raised full-year guidance again. This isn't just another solid quarter. This is Celestica continuing to ride the AI infrastructure wave hard. Hyperscalers, 800G switches, and the next generation of AI compute are all fueling serious growth. In this video, I'm breaking down the full Q2 results, the raised outlook, the segment strength, and what it means for the stock from here. And finally, I'll give you my personal take on why I like the stock right now. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. Now, if we look at the results, we can see Celestica had a very strong quarter across the board. Revenue came in at $4.7 billion, up 62% year over year, and significantly above the guidance range of $4.15 to $4.45 billion. GAAP EPS hit $3.17, up 74%. On the adjusted side, operating margin reached 8.2%, beating the 8% guide and improving 80 basis points year over year. And adjusted EPS came in at $2.54, up 83%, also a clear beat of the $2.14 to $2.34 range. Overall, a very clean and impressive set of numbers for the company. And when looking at some more key figures, we can see even stronger operational performance. Earnings from operations reached $458 million, up nearly $186 million both quarter over quarter and year over year. As a percentage of revenue, that came in at 9.8%, improving 3.1 points sequentially and 40 basis points year over year. Return on invested capital was particularly impressive. GAAP ROIC hit 65.8%, up over 20 points from last year, while adjusted ROIC came in at a very strong 55.5%. This figure basically shows how efficiently the company is using the capital invested in the business to generate profits, and these levels are exceptionally high. Overall, these numbers are very strong and clearly show that Celestica is running a highly profitable business. Looking at the segment breakdown, we can clearly see where the growth is coming from. The CCS segment, which is Connectivity and Cloud Solutions, delivered $3.81 billion in revenue, up an impressive 84% year over year, and now makes up 81% of total revenue. Inside CCS, communications grew 62% to $2.65 billion, while the enterprise business, servers and storage, exploded higher, up 167% to $1.16 billion. CCS also expanded its segment margin to 8.7%. Meanwhile, the ATS segment grew a more modest 8% to $888 million, with margin improving nicely to 6.3%. Overall, CCS is clearly the main growth engine right now, driven by strong AI and data center demand. Turning to cash flow, the trend here is clearly improving. Cash provided by operations has been climbing steadily, reaching $411 million in Q2, the highest level in recent quarters. Non-GAAP free cash flow came in at $147 million, remaining solid even as the company significantly ramped up investment. CapEx rose to $264 million, or 5.6% of revenue, as Celestica continues to expand capacity for the strong AI and data center demand. What's important is that despite this higher spending, free cash flow has stayed positive, and the overall cash generation trend remains healthy, showing the business can fund growth while still producing cash. Looking at the balance sheet, Celestica remains in a very strong financial position. As of June 30th, the company held $536 million in cash, with term loans of $740 million, resulting in net debt of just $204 million. Both GAAP and non-GAAP debt leverage ratios sit at a very low 0.5 times. Total liquidity stands at approximately $2.3 billion. This is a clean and conservative balance sheet that gives the company plenty of flexibility to keep investing in growth while staying financially solid. Looking ahead to the third quarter, management is guiding for continued strong growth. Revenue is expected between $5.25 billion and $5.55 billion. Adjusted operating margin is guided at 8.4%, and adjusted EPS is expected in the range of $2.88 to $3.08. They also estimate an adjusted effective tax rate of approximately 20%. This guidance points to another sequential step up in both revenue and earnings, showing that the strong momentum from Q2 is expected to continue. Looking at the end market outlook for the third quarter, the growth story remains very clear. Communications is expected to increase approximately 60% year over year. The enterprise segment, which includes servers and storage, is expected to grow around 190%, continuing the very strong AI compute demand we've been seeing. And the ATS segment is projected to grow in the mid-teens. This outlook shows that the AI and data center momentum is expected to stay strong heading into the second half of the year, especially on the enterprise side. One of the most important takeaways from this quarter is the raised full-year outlook. Management increased their 2026 revenue guidance to $20.5 billion, up from the previous $19 billion. Adjusted operating margin is now expected at 8.4%, and adjusted EPS has been raised to $11.30, up from $10.15. Free cash flow guidance was also lifted to $600 million. Looking further ahead, they noted that 2027 revenue growth is expected to accelerate compared to the strong 65% growth currently projected for 2026, and adjusted EPS is expected to grow even faster than revenue. This is a clear signal that management sees the AI-driven demand remaining strong well beyond this year. Looking at the broader business outlook, management expects the Connectivity and Cloud Solutions segment to grow approximately 85% in 2026, while Advanced Technology Solutions is expected to grow around 10%. On the communications side, growth is being driven by robust 800G switch demand, with 1.6T switch programs set to ramp in the second half of this year. And these trends are expected to support very strong growth into 2027. In the enterprise segment, AI compute demand continues to strengthen, with multiple program ramps expected to drive solid growth next year as well. They also highlighted strong demand from their hyperscaler customers, supported by multi-year capacity roadmaps and next-generation program awards. Overall, the outlook remains very constructive and positions Celestica well going forward. So after looking at the latest earnings and guidance, let's zoom out and look at the longer-term opportunity using what management laid out at their Investor Day. Celestica has gone through a clear multi-year transformation. They exited lower-margin businesses, invested heavily in engineering, and positioned themselves as a technology platform solutions provider, especially in AI networking and AI compute for data centers. Today, hyperscale programs already drive more than 40% of total revenue, and the company is recognized as a design leader and key technology enabler in AI data centers. Looking ahead, management sees multi-year demand strength. Hyperscalers continue to raise capital spending, digital native customers are investing heavily, and Celestica already has visibility into large-scale program ramps into 2027, including multiple 1.6T networking programs, AI rack-scale solutions, and next-generation compute platforms. They're also investing ahead of demand. In Texas, they're more than doubling square footage and increasing power capacity over 10 times by 2027 to create a manufacturing center of excellence for AI racks. They're expanding in Mexico, Thailand, and Malaysia as well to support high-power and liquid-cooled systems. From a financial standpoint, the priority is clear. Continue compounding adjusted EPS while maintaining sustainable margins, disciplined growth, and strong returns on invested capital. The 5-year track record already shows accelerating revenue growth, expanding margins, and very strong EPS compounding. Management's message is that these growth dynamics are expected to continue through 2027 and beyond. In short, Celestica is no longer just an EMS company. They've built a focused, high-growth platform business right in the middle of the AI infrastructure build-out, with the capacity, technology leadership, and customer relationships to keep compounding for multiple years if they execute well. So after looking at the long-term investment thesis for Celestica, let's look at analyst price targets for the stock. According to stock analysis data, 21 analysts currently rate Celestica a strong buy, with an average price target of $448. That represents upside of approximately 35% from current levels. The lowest target sits at $360, while the highest is $550, implying potential upside of about 66%. Overall, Wall Street remains constructive on the stock, following the strong quarter and raised guidance. Looking at the current valuation and performance of the stock, Celestica is trading at around $324, giving it a market capitalization of approximately $36.6 billion. Over the past year, the stock is up roughly 90%. On a trailing basis, the company is generating $15.6 billion in revenue and $1.1 billion in net income, with EPS of $9.62. The trailing PE sits at about 33.5 times, while the forward PE is lower at roughly 25 times. Overall, the market has rewarded the strong growth and raised outlook, though the valuation has expanded meaningfully over the past year. To wrap things up, Celestica just delivered another very strong quarter. Revenue grew 62%, adjusted EPS jumped 83%, and management raised full-year guidance once again. The company continues to execute extremely well in the highest growth parts of the data center, particularly AI networking with 800G and upcoming 1.6T switches, and AI compute on the enterprise side. They're not just riding the current wave, they're investing ahead of demand with major capacity expansions, and they already have visibility into large programs ramping into 2027. Management even expects revenue growth to accelerate further next year, with earnings growing even faster than revenue. While the stock has already had a strong run and the valuation has expanded, the combination of high growth, expanding margins, a clean balance sheet, and multi-year AI tailwinds still looks compelling to me. I'm personally bullish on Celestica. I like the stock, and I like the long-term opportunity in the AI infrastructure build-out. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching, and happy investing.